and welcome to Morningstar. I'm Emma Wall and I'm joined today by Ben Lofthouse from the Henderson International Income Trust to give his 3 stock picks. Hi Ben.
Morning.
So what's the first company today?
Well, I'll just set the scene by saying what we look for are well-invested companies that generate good free cash flow, that can pay their dividend and invest. So we like them where there's a little bit of maybe uncertainty or a contrarian aspect. So I'd say we're value but not deep value. So with that in mind, the first stock is General Electric. We've held this in the portfolio for a few years now. It is restructuring. It's built up a very large, it's a world-class industrial company, does turbines, engines for planes, locomotives, you name it. But it also had a very big finance area, and that grew significantly before the crisis. It's in this current environment with the higher capital requirements, it's not as profitable as it was, and the company, to its credit, is winding that down and selling it. They're getting some very attractive prices, and I think at the end of it you'll see a very good total return. The dividend is 3.4%. It's very well covered. It's been growing fast. And just yesterday, somebody else saw the light, and an activist investor has got involved as well. So it's in our top 10, and that's one of my key picks.
Would it then be time to sell if it's asset stripping now after the sale of that financial sector? Or is this one of these income stocks one holds for decades?
I think it's potentially one that you hold for decades. I think one of the things that the financial division does at the moment is, hide how good the industrial part of the business is. The management team there are very focused on making the profitability of the industrial business higher. And I think it's one of those leaders. It's one of those global leaders that actually has a lot of competitive advantage from its scale. So, for me, actually, we're at the start. So, we're in the first half of the transformation, and it's doing this without even a very good operating environment.
And what's the second company?
So the second company is slightly different. It's Novartis. So it's a large pharmaceutical company. It's in the top 10 as well. I think, again, it's a stock that's performed well. And one of the reasons I highlight it is, 4 or 5 years ago, the pharmaceutical sector was very unloved. We took a large weighting in the sector and it's performed well, and the temptation is to move on. I think what's interesting about Novartis is it had a management change 18 months ago. They, for many years, weren't perhaps as focused on profit as they could have been. A management team are focusing now more on profit. They have a pipeline, a drug pipeline that's coming through very strongly. But also, interestingly, for a pharmaceutical company, they have a company called Sandoz, which makes generics. So actually this pressure from the regulators and from healthcare providers to try and reduce the costs of drugs, they have one of the best companies in the world at providing those alternatives. And then to add to that, they've got one of the world-leading eye care divisions. So if you look at the cash it's generating, potentially in a few years it's got net cash, it yields 3%. I just think actually it's not a bad place to be in this environment.
Sounds quite diversified.
Yes, it is.
What's the third company then?
The third company, much smaller. It's a sort of €4 billion market cap. It's a company called Euro Commercial Properties. And so it's a REIT, so real estate investment trust, yields almost 5%, and it does European shopping malls, which, as you can imagine, haven't had the best time in the most recent years. It has a relatively high-quality portfolio, and it operates from Netherlands, France, Italy. We're starting to see a pickup in some of those countries, so actually Italian consumer confidence is looking better. But the main reason I think it's interesting is what we've seen in other countries when interest rates fall very significantly is that actually the value of property goes up. And it takes a while for the market to react to that. So at the moment, it's trading around book value, and the property yields are 5 to 6% on these very well let, so 98% occupancy shopping malls. I think by the time this is out, when French bonds, 10-year bonds are sub 1% at the moment, German 10-year bonds are sub 1%, I think it just looks like a very attractive asset.
Ben, thank you very much.
Thank you very much.
This is Emma Wall from Morningstar. Thank you for watching.